Welcome, Chris, Michelle, and Wendy. Great to see people joining in. Just test to make sure everybody can hear us. Jesse, can you?
I can hear you.
Yeah. Okay, great. We'll just we've got about 50 plus registrants, so we're going to give it just a minute for everybody to join. Oh, this is great. Lots of people signing in, so. Yeah, just bear with us, everyone. We're expecting 50 plus registrants. I see we've got about 15 that have joined so far, so I'll just give it another couple of minutes for people to sign in. I'd like to welcome everybody who has joined so far. We're just waiting for a number of other registrants to sign in, so please be patient with us. Still got a few more to come yet, folks, so just bear with us. Okay, well, in respect of everybody's schedule, we will get underway, and hopefully all of our registrants will join us in the next minute or two. I'm Ken Gibson, Director of Operations for Alberta Energy Efficiency Alliance, and I manage the Retrofit Vendor Network, and absolutely delighted that we are hosting on behalf of one of our vendors, FRESCo, who's going to give us a very informative presentation about clean energy tax credits. What I'd like to emphasize is that we have a wealth of expertise across 88 vendors, and I'd encourage all of our vendors to bring forward educational content to share with the building owner community and other vendors. I would note as well, folks, we are recording this session just for purposes of being able to capture all of the content. So if anyone has any objection to that, please let me know right away. Otherwise, we will continue to record. Jasmine, may I ask that you take us to the to the next slide, please. I just wanted to share that we have created a one-stop searchable directory to assist owners and their primes to be able to source the expertise that they need either to assess, design, construct, commission, and validate energy retrofits. The directory can be found at the AEEA website, which is simply aeea.ca. Next slide, please, Jasmine. Building owners can be assured that vendors have the necessary experience to meet your retrofit needs. Vendors must be able to demonstrate their experience in projects accredited by third-party standards, whether it's LEED, BOMA, or Energy Star as examples. And with that, I'm going to pass over to Peter Sundberg with FRESCo. Thank you.
Great. Thank you so much, Ken, for having us here today to talk about the Clean Technology Investment Tax Credit. Maybe the next slide, Jasmine. Just introducing myself. My name is Peter, and I'm the general manager and a senior consultant with FRESCo, who we'll introduce in a moment. And I'll be co-presenting with my colleague Jasmine, who did the amazing research for this project and put the presentation together for us. I'd like to thank her for that. Next slide. So just what I'd also like to thank is we are able to deliver this webinar today as we have funding from Natural Resources Canada through their Deep Retrofit Accelerator initiative. And this is a project that's been funded and hosted with Landlord BC, which is a market rental housing provider in British Columbia, and we're FRESCo. While we're based in BC, we do work across Canada, and the outputs of this project are also a national in scope. The project is called Building Financial and Workforce Capacity for Energy Retrofits, and its purpose is to develop a wide range of education and tools to support industry to build a better case for energy retrofits. So one of the education pieces is this webinar, and there's going to be a whole series more. Next slide. Quickly introducing FRESCo, we are a mechanical and electrical engineering firm, and we also do a huge range of policy research, strategic analysis, reporting, training and education like this, or in-person education. We design and deliver retrofit programs for utilities and government, and we do a whole wide range of assessments and other types of services. Next slide. So what we're going to cover today is what we'd like to do is give you a very broad and deep understanding of this tax credit. We want to talk about the key eligibility components. We want to talk about the labor requirements. We want to require about the documentation and timing. We want to talk about the long-term rules and the strategic implications. Next slide. And what we're hoping your takeaway, this is in some senses, this program could be complex. It's a tax program. We're not here to make you tax experts. We want to cut through all the dirt and tell you about how the program works. We want to tell you about the common pitfalls that we've been told about by accountants, contractors, building owners, and others that have been in the program. And we want to tell you why this evolving program matters for your retrofit projects. Next slide. So one of the things I want to just briefly talk about is how tax incentives support retrofits. One, they give you cash back, and we'll talk about that, to reduce your costs. They help you improve your financial returns and really build a better business case for retrofits. In many locations and for many types of retrofits, there are not financial incentives available. For example, there are fewer financial incentives for retrofits available in Alberta than there are in other provinces, but this is something that's available nationally, so it really can be used to build a better business case for your retrofits. And we also feel that this can enable more retrofits and deeper retrofits. So with access to this tax credit funding, you can go beyond basic upgrades, and you can also invest in more comprehensive solutions. Next slide. And one of the things we'd like to say is that this tax incentive has been a massive missed opportunity in Canada. They have a very large budget for this, but there's been very low uptake. And so it's been really underutilized by building owners and contractors, and we want to help change that. One is that there's been relatively low awareness. It hasn't been heavily promoted across Canada, so you might not have heard about it from many locations. Many people we talk to were telling you about it them for the first time, which we think is a shame for a federal program that we would like to see well utilized across Canada. Secondly, there's been really limited experience with building owners, with contractors, and even with accountants that support it. Lots of people, because there's been low uptake, there's low experience with it. There has been some uncertainty, and we'll talk about that, about amount of the money people is going to get back. So that has scared some people away from participating in the program, and we'd like to provide more details on how you can get more certainty. And secondly, it does require some expertise. Like the first time anyone goes through it, an engineer, an accountant, a contractor, a building owner, it's going to be more difficult. There is a bit of a learning curve. So by participating in things like this, and the building owners that we've gone through it one time, they realize, oh, okay, well, this wasn't as complicated as I anticipated. Once you've gone through it and participated and understood some of the details, it does become something that can be quite accessible. So next slide. So just in a really brief, broad brush over, so we wanted to talk about understanding of tax credits. So there's two different types of tax credits. One's refundable. So if the credit exceeds your taxes, like you pay whatever amount of taxes, you still get money back regardless of how much taxes you pay. And this is what the tax credit we're talking about today. This federal tax credit is refundable, which is the best type of tax credit. The other types of tax credits are non-refundable. That means you can reduce your taxes to zero, but beyond that, no additional money is paid out. So even with corporations that were able to reduce their tax to zero for any given number of reasons, they can still get cash back. Very importantly, tax credits can help you offset capital costs, improve affordability of retrofits, and just strengthen that overall business case for retrofits. Next slide. And with this, I'm going to pass this off to my colleague, Jasmine, who's going to run you through the various intricacies and elements of this tax credit program. Again, if you have questions as you go through, please type them into the chat. I'll be monitoring and responding as we go. And then again, if your question doesn't get answered within this, you can, we will respond with answers to all questions after this in detail and provide you with information where you know you can get follow-up information. Thank you. Over to you, Jasmine.
Thank you, Peter, and hi, everyone. So now that Peter's given us a bit of an understanding into the different types of tax credits very, very broadly, we know that a refundable tax credit means, exactly as Peter said, you know, you can continue to get money back even if your taxes are zero that are owed. So that's really important kind of going forward in talking about the Clean Technology Investment Tax Credit. I'll also refer to it as CT ITC kind of going forward. So this is one of the most significant federal incentives available right now for building retrofits. And it's helpful because eligible claimants can receive up to 30% back on the cost of eligible equipment. So I guess very broadly talking about the tax credit overall, so the CTITC is a part of Canada's broader federal clean economy strategy. And in 2022, the federal government released a fall economic statement, which had Budget 2023 following. Inside of this, there was a suite of clean economy investment tax credits, and these are essentially designed to help accelerate private sector investment into clean energy equipment. So the CTITC is one of several credits that are kind of in that broader package, and the CTITC is going to be jointly the responsibility of both NRCan and CRA. So NRCan is responsible for defining the technical components and things like the type of equipment that would qualify. Whereas obviously, since this is a vehicle that's attached to the tax return, it's no surprise that CRA is going to be responsible for overseeing and controlling how the claim is actually going to be enforced. So, most people think that CTITC functions like typical building retrofit programs, incentives, or other types of rebates. So, I think it's kind of important to make the distinction early on that this isn't a grant. It's not going to be performance-based. It's not tied to any specific amount of energy savings. This is a tax credit and it's installed for specific types of clean equipment, clean technology equipment. So there's no approval letter that you get before you'd start construction. You're not going to get confirmation from the government that you qualify ahead of time so that you can go forward. You would go forward with your project and you claim this through your corporate tax filing, which means that everything like your eligibility documentation, it has to stand up to the audit that would come after the fact. So when we talk about eligibility, it's really good to think about the following like 5 key components here. So it's not as simple as like, does a heat pump qualify? You have to kind of understand who is claiming, what type of equipment would qualify, the costs that would be involved, what are the broader project conditions, and what happens after you claim. So all these pieces will be working together, and these will essentially help kind of paint the picture of where you might have a successful claim. So we're going to, we went forward a lot. Okay, so we're going to backtrack here a little bit, and we're going to talk about first the eligible claimant. So we're going to talk about who can actually claim the credit. So the credit is available to taxable Canadian corporations, partnerships, and certain REIT structures, mutual fund trusts specifically. The ownership structure actually matters a lot. You may assume eligibility, but the holding structure can really complicate things. So determining if an entity is eligible will be one of the first conversations that you're going to want to have if you're trying to figure out if this tax credit is a good fit. The only requirement for the type of building that the equipment is installed in would be that it's owned by the claimant and it's used for income earning purposes. So this isn't like a residential homeowner program. This is going to be commercial and for income property, income generating property. So I wanted to specifically talk about partnerships and at-risk limits. So when a partnership owns a building, the credit doesn't stay at the partnership level. It will actually flow through to the individual partners. So each partner will claim their share of the credit personally. There is an additional rule that's really important to highlight here called the at-risk rule. So what this means is that a partner cannot claim more credit than the amount of capital they actually have at risk in the project. Or in other words, this means the amount that they've truly invested and could realistically lose. So if a project is heavily debt financed, through like loans and the partners themselves have only contributed a very small amount of equity, then that usable portion of their credit will be limited. It doesn't mean that the project is wholly ineligible. It just means that from a practical perspective, the full amount of their credit that could be realized may not be accessible to each partner, depending on their financial exposure. So the early coordination is really important here. I'm going to highlight that throughout the rest of the presentation, but especially with partnership structures, you really want to make sure that you're understanding how much of the credit can actually be used. And yeah, so I guess to kind of situate all of this, the CTITC is not based on like revenue. There's no requirement for a specific number of employees you need to have, you know, any of those kind of details. There's no like size test. It's mostly just that you're an eligible corporation and you meet these other requirements that we're going to talk about. So it could be for small or large businesses that's making a qualifying investment into eligible property. So we're now going to get into the eligible equipment. We're going to talk about what types of equipment categories qualify. So this is sometimes where the expectations need to be reset slightly. So the CT ITC is equipment specific. It isn't scope based. So these are eligible categories of relevant types of retrofits that we see in buildings. There are other equipment categories that are included in the CT ITC. We haven't listed them just because they're not relevant to building retrofits. So these are the 4 that we've picked out. We have air source heat pumps, ground source heat pumps, solar panels, and there's battery storage. So when we look at that list specifically through the lens of a building retrofit, we are going to really pick out air source heat pumps and ground source heat pumps as the equipment types to focus in on. So those systems can support like space heating retrofits with cooling added. They can also apply to domestic hot water retrofits as well. For the rest of the section, I'm mainly going to focus on the heat pumps because that is where we see the most activity, but I did want to flag again, solar panels and battery energy storage are also eligible. From conversations I've had with accountants, they've actually said that solar in particular is considered to be very much a slam dunk case for this credit. The eligibility tends to be much clearer and more straightforward compared to like the heat pump, for example. So it is good to know that if you were interested in solar panels, that this credit really could work for you. So then just really quickly talking about what type of retrofits this credit just cannot support. So window upgrades, insulation, air sealing, any type of shading or passive strategies, any type of standard ventilation, and like broad scale electrical capacity service upgrades. Unfortunately, those are not going to be eligible for any type of reimbursement under this credit. So we're really just looking at the heat pumps and solar and battery. So there are a few other additional eligibility requirements that I'm just going to highlight here. So beyond having the right type of equipment, first, the equipment needs to be new. It can't have been previously used or refurbished. Second is that it needs to be installed and available for use in Canada. And the last is that it needs to meet any of the prescribed technical standards for the equipment category. NRCan has released guidance for equipment, kind of explaining what schematics it would need to match or what requirements it would need to obtain in order to be eligible. So a few other key takeaways that I would emphasize here is that there is no master list of approved equipment. The eligibility will be determined case by case based on how the equipment meets legislation and technical guidance. And also, this applies to specific pieces of equipment. So your entire retrofit project may not be eligible. And you don't get to claim the whole like mechanical room renovation. You'd only be able to claim the eligible equipment within that. The third important takeaway is that the equipment can be a part of a hybrid or dual fuel system. It's just that the only eligible components will be those air source heat pump or ground source heat pump portions. Nothing that's gas related or any other components outside of the eligible equipment would be able to be reimbursed. So there's some additional requirements. This is a really important distinction, and it's understanding like what parts of a heat pump system could qualify. So we've created these 3 different categories of primary, supporting, and secondary types of equipment. So one of the most important technical nuances is how the equipment is actually going to be categorized. This will affect eligibility and much more. So the primary equipment is any core heat pump equipment, pieces of equipment. So we're talking about like the indoor and outdoor units, compressors, any of the core pieces of equipment when you're thinking of an air source heat pump or a ground source heat pump are going to fall into kind of that category, and those will be eligible. You also have supporting equipment. So this is other types of equipment pieces that are required for that primary piece to function. So control systems would be included in this, any dedicated electrical connection, refrigerant loops within the heat pump loop would be also considered. And then what kind of falls outside of this would be secondary building infrastructure. So any other building infrastructure that may need to be completed, such as like I don't know, coring or additional drywall repairs. If you need like a larger electrical capacity upgrade in your building, unfortunately, those won't be able to be eligible for this tax credit. So it's important to kind of understand what falls in that category. What was actually a bit of a surprise to our company when we were researching this is that distribution systems for the building will also not be included. So if you have a domestic hot water system, your piping that brings that hot water throughout the building actually won't be eligible. Or if you have like ducting that's needed throughout the building to move hot air or cold air throughout the building, that ductwork also wouldn't be eligible. So I have a really common example here, just to kind of highlight exactly what I was just talking about. So here we have a ducted air source heat pump system that's paired with a natural gas furnace. So we have a bit of a hybrid system. On the left, you can see highlighted in the green, you see the outdoor heat pump unit, there's the indoor unit, and then all of the components between them. So that's considered the primary and supporting eligible equipment under CT ITC. It means that the outdoor condenser and the indoor air handler, any of the components that are required to make the heat pump function would qualify. On the right-hand side, you can see that we have a natural gas furnace and we have the ductwork. So those are going to be secondary, they're complementary, but not necessarily required for the heat pump equipment to function. So therefore, those would not be eligible. So with some of the uncertainty that's around what's eligible and not eligible, you can request a non-binding technical opinion from NRCan. So this would require providing them with a detailed equipment list, the type of system that you have in mind, the schematics, and you would typically require the assistance of an engineer or technical professional to be able to package together and send off to them. This is not mandatory and the opinion is not binding, but it is recommended because it can provide some clarity if you're unsure of whether an entire system would qualify or what parts of your project would meet the qualification requirements for technology. And really quickly, we're going to talk about just eligible costs. So the credit applies to capital costs that are directly attributable to the eligible equipment. So this would be, again, that primary core pieces of equipment and any necessary supporting components. So not the full retrofit. Your electrical upgrades are not going to be included. If your retrofit is $2 million and only $800,000 of that is eligible heat pump equipment, then the credit would only apply to that $800,000. So an important nuance here is that if you're stacking this with rebates or incentives, the tax credit will apply to your net out-of-pocket costs after rebates and incentives. It's important to note that the program is evolving and there were recently proposed changes to have engineering and design fees removed as eligible costs. So it's good to always kind of stay informed and double check which costs are allowed or disallowed. And now we're going to talk about eligible project conditions. So this is where the program kind of shifts from technical to more operational. So up to this point, we've talked about the claimant, we've talked about the equipment, and we've talked about the cost eligibility. So this credit does have a labor requirement, and this is where really the compliance risk kind of enters the conversation. So if you meet the labor requirement, you can access the full 30% tax credit. If you don't, then that credit will drop down to 20%. And what many owners may not realize is that accessing the full 30% comes with a pretty significant administrative responsibility. So what is the labor requirement? So the optional labor requirement that's tied to this credit will be the prevailing wage and apprenticeship participation. So the prevailing wage requirement would mean that covered workers at the installation site are paid at or above the applicable union equivalent wage rate for that trade and region. The apprenticeship requirement means that a minimum percentage of the total hours of the work that's performed on site is performed by apprentices in red seal trades. So again, if you aren't able to meet that or don't elect to meet the labor requirement, your credit will drop to 20%. So which workers will this apply to? So the labor requirement would apply to individuals that are performing manual or physical work related to preparing or installing eligible equipment at the site. So this would include any workers that are employed by general contractors, their subcontractors, and any installation crews. So this would not apply to engineers doing design work in their own office or to accountants. This applies really to the physical on-site labor. So to access the 30%, you need to elect that you've met the labor requirement and attest that you've complied with the requirements. You also need to maintain documentation. So the important thing to kind of highlight here is that the documentation really needs to exist at the time of work. A lot of it can't be recreated later. We have a list here of just the different types of documentation that may be included. And the CRA has been very, very clear that claims and supporting documents will be subject to audit. We heard a story from one accountant who told us that they were processing a claim, and there's also requirements for job site postage to be on site. You need to kind of advertise that the site is a site where workers are paid the prevailing wage. So this one building owner had gone through with a specific type of installation. They had the job site postage, but they didn't have a photo to prove that that postage was actually on site. And their credit was reduced from 30 to 20 because they didn't have a time-stamped photo that indicated that there was proper job signage on site during the time of installation. So that's obviously really frustrating, and it really does just kind of point to why this really high burden of specific documentation really is a bit of a barrier here, and why it's really important to be well informed going into this if you're trying to meet that 30% threshold. So the other thing to highlight here is really with just about risk. So even if a contractor assures an owner that they're compliant, the claimant at the end of the day is the person that will be ultimately responsible. So if labor documentation can't be substantiated, CRA can reduce that credit from 30 to 20. And from a practical standpoint, the labor compliance really needs to be addressed from the beginning. This isn't really something you'd solve after installation. If you're electing into that full 30%, the compliance language will need to be built into your contractor's agreements. This would include the prevailing wage obligations, the apprenticeship hour targets, and any needed documentation. The contractor would be responsible for maintaining these detailed records and providing them to you, but at the end of the day, you're the one that's responsible if you're the building owner. And yeah, it's kind of important, I guess, to kind of remember that where the risk really falls. So something that has kind of come up is just talking about that practical element here in the conversation of whether that additional 10% is worth the compliance burden and the risk. So on larger projects, that 10% can obviously represent like a very large number and hundreds of thousands of dollars. So the answer might be yes with trying to meet the labor requirement. But on a smaller project, the incremental value just might not justify the administrative complexity. So we have seen some owners strategically choose the reduced 20% rate right off the bat, and that decision should be made before installation begins. This also kind of points to why it's really hard retroactively to decide to comply. And early coordination would be really important between the contractor, the owner, and tax professionals that are really guiding the application here. And then filing an audit readiness. The credit is claimed through your annual corporate tax return. This would be a T2 for corporations or T3 for trusts. So any supporting schedules and documentation would need to accompany that filing. The practical takeaway here is that audit readiness really does start right away, and you need to start that during procurement and installation and planning. The CRA can review all of your documentation, and if the documentation systems aren't built into the project delivery from day one, it could be very difficult, sometimes impossible, or time-consuming to reconstruct all that information later. And now to talk about the ongoing eligibility. So after we kind of move beyond the claim, maybe your claim's been approved, the CT ITC has long-term conditions and ongoing eligibility requirements that would need to be met. So the equipment is expected to remain owned and in eligible income-producing use for up to 10 years. So this isn't really like a claim and forget it type of incentive. There is a recapture risk. So recapture can occur if the equipment is sold, if it's removed from service, if it's converted to non-income use, or if there's ownership changes as well. So if triggered, part or all of the credit could be repaid. Typically, we see that repayment is proportional to the remaining asset life. But again, this can vary case by case. So this really does matter in building sale scenarios, refinancing, you're doing other major renovations. So the tax credit really should be part of long-term asset planning, not just an immediate retrofit. And to just talk about some key takeaways. So CTITC is a major opportunity. The 30% credit really is substantial. And for the right claimant and project, this really can materially shift your financial return. As we can see, it's not very simple. I really have only scraped the iceberg here with kind of explaining at a very high level how this program works. So we can understand maybe why, uptake in this has been low. But if you have good structured planning and you have professional support, like Peter said, this really can be attainable. The labor compliance is the highest risk area. When I was speaking to some people I knew at CRA, they were mentioning that the labor requirement is unanimously the hardest, most difficult compliance aspect of the credit. And you have to kind of make that decision of whether it makes sense to go forward with the 30% or 20% decision, kind of on the onset of the project planning. The documentation really is going to be a determinant of success. It needs to be intentional, and it needs to be pretty meticulous. And then finally, the early coordination just kind of avoids any surprises later on. So the project team really here does matter. The credit really does sit kind of at the intersection of tax and engineering and construction, and you need all of those to be aligned well. So your tax professional is not just filing a form, they're really going to be essential in helping to guide eligibility, structuring the claim strategy, assessing risk, and they'd be very pivotal to an application. The engineer is going to be designing the system. They'll also provide input on technical criteria, helping to make sure that documentation that's needed to substantiate the technical requirements of the credit can be proven. And contractors don't just install equipment, they're really doing a lot of work if you're trying to meet that labor requirement, trying to prove the way that the project has flowed and tracking different statistics about how the job's been completed. Also, even like separating eligible from non-eligible costs, as would be needed to do to show what can be claimed and what can't. So the roles are pretty clear, and the expertise really will matter. And I guess just on a final note, retrofit decisions are very much financial decisions, and programs like CTITC can help to accelerate and shift and help retrofits actually happen. In this case, they really do need coordination. There's clarity, and you have to be quite disciplined with following the rules, but the payback can be really, really significant. So in being deliberate as an industry, we can more effectively leverage tools like this, and I think that's kind of the ultimate goal. So Peter, I don't know if there's questions or...
If anyone does want to go on mic and ask questions, we are available for the balance of time to answer any questions. Alternatively, if you need to ponder and think about it, you can send questions to the email below, and we'd be happy to respond to those. I believe the presentation will be sent out, and there will be likely some other opportunities to present and or speak on this. And just so you know, we will be doing more webinars and training on a range of different topics later this year, including financing options, how to build a business case for a retrofit, and we'll be in contact with the Alberta Energy Efficiency Alliance to co-deliver, and or some will be available in other jurisdictions that individuals can join as well. So if there's any questions, please let us know. And if not, we really appreciate and value your time for being here today. It was a pleasure presenting to you. I see Lauren. Right, to take yourself off mic, top right corner.
Yeah, got it. Thank you for the presentation. I run a government subsidized affordable housing organization. So it's looking like we would probably not qualify for this because we don't actually pay tax. Now, I was apologize, I was a few minutes late. And yeah. Peter, I just caught where there is, if you don't pay tax, there is a provision for still getting some funding back. And my second question would be, if you're talking about heat pumps and that, how is that related to income?
So income, this is for income generating properties. So if someone was a commercial business that's being used for business, it would be. If you were running a market rental apartment and it was a rental apartment, that is an income generating business. And I'll let maybe Jasmine respond to the nonprofit if there's any opportunities. I think it's not designed typically for nonprofit or non-business operations, but I'll let Jasmine.
Okay, thanks,
yeah. So I'm not gonna speak directly to your specific case, but I will say that I have overheard that there were abilities for nonprofits to be able to partner in very specific scenarios with other corporate entities, but I think I would talk to a tax professional at the end of the day because truly I don't know enough really to be able to speak to your exact scenario. There is potentially a loophole that can be leveraged, but from everything that I've heard from accountants, that structuring from the onset is really so important. So you'd want to make sure that however you kind of are structured is meeting the requirements of this program.
Okay, great. Thanks, Jasmine.
And for any contractors on the call, we do, while there is some burden to participating in this type of program, like learning how to do it and having the systems in place to do it. Once your systems are in place to do it, tracking labor hours and what have you and whatnot, the contractors we told, and separating your eligible for non-eligible expenses, which you might not typically do. You might not be typically designing your invoice or structures that way, but by doing so and creating systems, it can be there's large value to you in doing that, either creating a competitive advantage against other firms that don't do it, as you could bring significant financial value to your clients that can make a big difference in terms of enabling that client to do something and or to do more. So for those types of contractors that sell eligible type equipment, it really does, it really can, really pay to put the systems in place and learn and understand on how to package this with what you're selling a retrofit project. So we do highly recommend contractors take more time to do that. This presentation is available to you. There's a guide that we're developing that's being updated with all the new returns on it too, that will be distributed through the Alberta Energy Efficiency Alliance as well, that goes into sort of the more details that you might want a staffer, either from if you run a business, you're putting this together, or you're a contractor, that you would want those people to read that guide because it gives you the details of like how to effectively do it. And as Jasmine mentioned, engaging an accountant earlier just for the little, making sure all the key elements are together is always recommended as well. And they might say, give you advice on, what it might cost, because there would be an accountant cost for doing this too. So that's why smaller projects might not make sense, because if, the accountant's going to charge you money and your project's not large enough and the compliance costs are too high, then it just might be not worth your time. But for larger projects, it becomes increasingly more beneficial, particularly if your team on it is well organized to put it together, then the costs don't have to be too high.
So, Peter, Michelle Hauer had a question. Is there an end date for when the tax credit will be available?
Yes, it's till it's till December 2034. So there's a significant amount of time left. So again, that's not something thankfully, you don't have to rush into, as these things are larger projects that you may be planning. There's significant time left. Over the years, I'm sure that the program will change in terms of eligibility requirements and various things, as it is an evolving program. So it's important when you enter the program that you take stock of any changing rules that may have occurred. And again, we encourage folks to get that technical opinion from NRCan as well at an early stage if you're working on a project, just so that you're getting a confirmation. It's a non-binding confirmation, but they give quite a valuable amount we've been through it. They give quite a valuable amount of information that really helps you get your project on track. And Jasmine's email is there, so you can send questions to her as well. So yeah, but we're still available for other questions if there are any. Great. Well, with that, I'd just like to thank, I see one more coming in. Does NRCan look at technologies that aren't formally listed? Well, I think it falls into the broad bucket categories that Jasmine mentioned. Again, it may be expanded in the future to different things, but they're sort of, I think, it has to sort of fall into those broad bucket categories of what Jasmine mentioned earlier, which was air source and ground source heat pumps, solar, and battery. There are some other technologies that weren't related to building retrofits that we didn't go over today. So your other technologies may be eligible. There's not we're specifically focusing on building retrofits today. So there are other technologies beyond that we just didn't go into today. So,
and I guess to build off of what Peter is saying as well, those equipment categories are important, but like going deeper into it, there is NRCan has on their website, they have different types of schematic drawings and more detailed technical information that you would need to meet. So if you do have questions about like where your technology might fit, you might be able to read through some of those resources or talk to a technical professional, and they'd be able to provide you with more information as to like whether the type of equipment that you're thinking of might fit into one of these categories and meet that very prescriptive type of technological requirement of the property that you're thinking of. Michelle, I think you have a question.
Yeah, can you hear me?
Yeah.
yes.
Okay. I was wondering if you could elaborate a little bit on where you said a project that is heavily debt financed wouldn't necessarily be able to access the whole credit. Are there certain types of debt that would have that effect and others that wouldn't? If someone's taking out a typical loan versus if they're in like an energy service contract. Yeah, just wondering if you could tell us a little more about that.
Yeah, so for the actual debt requirement that that speaks to like partnerships. And again, please check all this information with your accountant. because they'll be able to really provide you with the information you need to your specific scenario. But I think the idea was that specifically for partnerships, there is like this debt kind of at-risk consideration where they don't want like people in a partnership to be able to benefit from loaned money where they're not necessarily liable. So it has to do with the partnership structure and the type of loan, and about like the at-risk liable aspect of that entity. So it would not be every type of loan, but again, it's very like specific to the type of partnership and the type of loan. So yeah, it'd be best to probably speak to an accountant on specific types of scenarios because I myself just am not knowledgeable enough to be able to provide more information other than just kind of the general oversight and knowledge of that. Like in certain partnerships, there is the at-risk consideration, and it's just important to really kind of comb through the type of financing structure that you'd be looking at in a partnership to make sure that you'd be able to claim that full amount.
And
Okay.
we do know as well, let's just say there's a larger project and there's tax credit eligible equipment and non-eligible equipment. If someone was getting a loan to cover part of their retrofit, you would strategically structure that so the loan was covering the non-eligible components and the building owner's cash was paying for the eligible components.
Okay.
If someone was not taking a full loan out for it, they were covering X% of it based on financing, for example. So there are ways you can, I guess, work the system if you're in that case to use cash for eligible equipment and loans for non-eligible, because there often is expenses beyond, again, electrical capacity upgrades may be one. This might be part of a larger retrofit where they're doing a roofing upgrade too, and there's other building envelope upgrade costs. Often these retrofits happen as part of a larger retrofit, and it's going to cover a portion. So there are ways to strategically design and plan your project out to maximize tax credits. And that is what, why you'd want to bring a team together to say, how can we achieve, how can we maximize our project one way or the other, accessing financing, accessing this tax credit, and doing all the pieces we need to do. And that's where sort of planning comes in at the early stage. As Jasmine had mentioned, in multiple cases, like plan the project out of how you're going to work it, how you're going to finance it, how you're going to, who's going to help you, because there are ways to work within it.
Okay, yeah. Gotcha. Thank you.
Great. These are great questions, by the way. And that last one was a tricky one, but I think, yeah, again, open for any additional. I guess we'll, if again, we're open and available to speak to it again. And if there was high interest in this thing again, please let Ken know. And we're happy to be happy to deliver again if there's significant interest, is provided Ken's interested. And stay tuned for the slides, and that will be sent out shortly after.
Well, again,
thank you very much.
The Alliance would like to thank both Peter and Jasmine for an excellent, informative presentation, for all of you attending. And I would encourage all vendors, if you have other educational content that you would also like to share with the community, consider partnering with the Alliance. And to our building owner participants, if you have burning questions that you would like some educational content to be shared, please don't hesitate to reach out and let us know. And with that, thank you, and we'll look forward to the next event down the road. Thanks, everyone. Take care.
Great, Ken. Well, I think that went well. We'll follow up if with the sending the slide package, including you want your slides incorporated within that package too, I think, yes.
Sure, that'd be fine. Thank you.
Okay, great, Ken. We'll touch base again soon offline.
Okay, thanks, Peter.
Take care.
Take care. Bye-bye.